Hi, everybody. So there was a brief show of hands before that I did not get to see. How many people have raised money, want to raise money, terrified of raising money? Any hands up? Fantastic. How many folks have already raised money, like in the last 12 months? Call it something north of $500,000. Great. How many folks in the room have raised across their career something north of $5 million? I see one hand in the back, and man, he looks like he's already been through the ringer, so nice work. I work for a company called Enjoy the Work. Our mission in the world is to fill in this gap that exists in our perspective, and that is who teaches the founder to be better at their job? Who teaches the founder in a way that is safe, a way that is comfortable, with all the stuff that comes around the corner? Because generally speaking, to become a good founder means to be a bad founder for a while. Enjoy the Work is my fourth company. I started my career in Las Vegas, of all places. So I worked in casinos for 13 years. I know that sounds strange. My family has been in and out of gambling, both in naughty and not naughty ways, going back 4 generations. I was playing poker by the time I was 4. I was going to the track by the time I was 7. Somehow I found enough maturity to actually get through school. But I went into gaming because that's what I wanted to do. And I started in analytics roles, and then I ran marketing, and then I ran sales, until eventually I ran my own casino company. It was about a $150 million revenue business, 3,000 employees. Sadly, though, it found me at the exact same time that I started to become mature enough to realize that living in Las Vegas was not a healthy long-term choice. So I decided to shift my life, and I moved to San Francisco in 2008. And I started my first company, a company that is not Twitter. That would be amazing. But no, I started a company called Truval. It was an analytics business targeted back at hospitality. And that business kind of worked. We raised a couple of rounds of venture. We were around for 4 years. Our customers were Starwood and Marriott and Hilton. And we sold the business successfully in 2012. And so suddenly, instead of being a casino guy, I was a startup person, and it seemed to happen overnight. And I was enough of a masochist that I decided to do it again. And I joined another business. This time, the company's called Talia. And I joined that business as the first non-founding officer. I was their president. And I joined when we were $200,000 in revenue and built the business over the course of the next few years to $20 million in revenue, and had raised about $100 million in capital over that time. So at this point in my career, I had had multiple stops where I had run both a big public thing and then a large private business and then my own startup, and I had seen this pattern that it seemed to exist. And this pattern was all company building. Frankly, all founders seem to ask the same questions at the same stages of company maturity. And if they all ask the same questions, there had to be best-in-class frameworks to get at those answers in the most efficient way possible, because the one thing that startups have is very little time. Either move fast or die. So I started a company called Enjoy the Work, otherwise known as ETW. This was 5 years ago. My bio will end shortly, and then I will get into the agenda of this talk. I promise it's relevant. And what we do is now 5 years later, we have a portfolio of dozens of companies, from giants like WeWork to small startups where there are 3 people in a prototype, where we work with them to identify what's the milestone that's ahead, how do we get there, what skills need to be trained. And one of the primary skills that need to be trained is fundraising. Fundraising is not just a pitch deck, it's not just a demo day, and it is, in fact, a dark art. There are ways of learning the game. And when you're raising money, particularly when you're raising money from professional investors, when you're raising money from venture capitalists, what's important to know is that the person across from you is better at this than you. This is all they do. I'd love a guess, if someone wouldn't mind screaming it out in the audience. If you're in one of the primary startup markets in the world, let's call it Boston, New York, San Francisco as examples, and I'm a seed stage investor, how many companies do you think that person sees in a year? I heard 10,000, which would be frickin' amazing. Other guesses? Yeah, I heard 1,000, double that, and you're close. So they're seeing 2,000 companies a year. How many investments is that investor making? Yeah, I heard 5, so call it like 10 to 12. 2,000 into 10 or 12. So how much time do you think you have to make an impression? 60 seconds. You have an incredible small amount of time. And this is one of the points that I want you to get across to you really quickly before we start working in through the framework. Fundraising is not luck. Fundraising isn't just a guess. It's not just a headline in TechCrunch that someone got struck by lightning. The best fundraisers run a process, and I'm here to talk you through that process. Because raising money, if I were to interview most of the entrepreneurs in this audience, most of them would tell me they have a venture fundable business. And yet only 1 out of every 100 startups actually has a venture fundable business. And that dichotomy is painful. But what can help the entrepreneur is knowing how to have the kind of empathy for that investor. What is the lens through which they view you? OK, so you're having trouble raising. How many people have tried to fundraise, and it's actually been hard? Great, there are like 4 of you willing to be honest. I would love to meet the 4 of you later. The rest of you, screw off. You're all full of shit. My first startup, 120 pitches, did not take salary for 18 months before we got to first term sheet. I got turned down 119 times. The amount of like Advil and wine involved in that year and a half was extraordinary for me. Most people can't raise, and it's one of 3 reasons. 1 is they lack traction for their stage. 2 is they're talking to the wrong investor. Or 3, and this is the one I can help you with today, you simply don't know how to raise. You think it's a pitch deck and nothing else. All good fundraisers come down to 3 pillars. The great founders work on all 3 pillars before they start fundraising. You're running a business. It's gotten kind of interesting. You have some traction. You're excited about it. You're sharing it with everyone who will listen. And an investor hears the story, and they're curious to learn more. They meet with you a first time. They're going to say things that are really positive. They're going to ask you a bunch of questions. You think you crushed the meeting because the person in front of you is smiling and engaged. Generally speaking, you have no idea what they're actually asking you. And what they've just done is start you in a fundraising cycle, and you're not ready for it. First rule of fundraising, don't fundraise till you're ready to fundraise. And that means mapping out in advance all of the pieces that the investor needs to understand about you before they're going to write you any kind of significant check. 3 pillars: the pitch, the materials, the investors. We're going to go into each of them. And for those who are curious, by the way, this deck, this video will be up. If someone sends me an email after, I'll send the slides. OK, number 1. When you're going to meet with an investor, there is no such thing as meeting with an investor that's not a pitch. I don't care if it's 30 seconds standing at the bar or a formal meeting in their boardroom. It's always a pitch. Which means get yourself in a good mood. That's not always easy. There was a joke at my last company. They knew when we were fundraising because our office in Soma had a balcony off the back of it. And so every time they saw me in a rather strange setup, like I'd be outside with headphones on, jumping around, doing push-ups or listening to music, they're like, oh, yeah, Jonathan's fundraising again. Because, and I'll play a little game with me if you guys don't mind. Close your eyes just for a minute, not even a minute, seconds. Here's what I would like you to do. Your eyes aren't closed. Thank you. I would like you guys, by a show of hands, to raise your hand if you know if I'm smiling or not right now. Now put your hands up if I'm not smiling. Open your eyes. You were all right both times, and your eyes were closed. So what does that mean? It means get yourself in a good mood. The other person knows it. They know it even if you're on the phone. Do whatever you need to get there. But a good mood doesn't mean that you're a pleaser. When you meet with an investor, you're in charge. And the phrase we like to use internally is, I would like you to be arrogantly likable. How long does it take, how many years does it take for the average venture-backed startup to reach a good exit? Just crickets. Like, right? Like, this is just early afternoon, insufficiently caffeinated, lunch is starting to hit our bloodstream.
Different people say different things.
4 to 6 years, 10 years, 10, 8.2 is the last math. For a positive exit, $100 million over, common stock actually received money. Last math was 8.2 years. Year before that, the average was 7.6 if you take a cohort view going back the last decade. Why does that matter? Because the investor that's meeting with you is evaluating, do I want to be in the room with this person for 8 years? And does this person evoke for me a sense that they're so in charge that I want to follow them? And here's the kicker. I want to trust a portion of my career to them. If you don't remember anything about this talk, you don't remember my name, you don't remember enjoy the work, none of it, remember one thing about fundraising with venture capital. They only get fired for the deals they do. An investor only loses their job for the bad deals they do, not the great deals they missed. So they're going to approach you with a hugely skeptical eye, and they should. So if you are in charge but likable, you are already alleviating one of their concerns, that you are the person that can lead an organization. The next thing is, for those who are here, who's thinking about fundraising and it's the first time in their life doing it? Great. It is, I'm going to say something that will be really hard for you to embody, but I would like you to remember it anyway and write it on a flashcard or put it on a sticky on the back of your laptop. It is impossible when you're fundraising for the first time to not feel like you're begging for money. And look, no one gives money to the needy person. No one dates the graspy person. No one wants to be in a long-term relationship with the citizen. Hey, do you like me? So how do you show up in that room realizing that the investor is just as fortunate to be sitting with you and your opportunity as you are with them, and it's a meeting of peers evaluating whether there's a fit? Energetically, you might not feel that way. At least try and trick your brain into it. Part of the way that will start is I want you, at the beginning of these meetings with investors, I want you to ask them questions. You will signal two things about this by asking them questions. One, you're not a rookie, and you're here to qualify whether or not you're a good fit for one another. And two, you're going to learn really important things about the person in front of you. Tell me about your investment thesis. What do you guys invest in? What don't you invest in? What is your typical check size? How much money is left in your fund? Have you already invested in anything that looks like us that could potentially be a conflict? And if you're trying to raise a sizable amount of money, which varies depending on where you are in the world and if you're hardware or software, or if you're medtech or consumer, like there's some variation to that. But if you are trying to raise a sizable enough amount of money where you need a traditional lead investor, someone who is going to take the first swing, ask the person in front of you, do you lead? Because if you need a lead and you're spending a lot of time with someone who doesn't lead, you are wasting your own time. And time is your constraint. The difference between startups and all other businesses is startups have to move fast or perish. So anything that eats at your time is dangerous. And last but not least, don't be scared of just walking into the room and saying, before I even get started in this pitch, let's see if we make sense for one another. That doesn't mean you shouldn't do some homework in advance, but there are some venture capital websites out there that will tell you nothing. Nothing. Barely even tell you the companies that they've already invested in, so you'll need to do some of the qualification in person. Once you've done that, first pillar is the pitch. You guys have all seen 1,000 different pitch examples. I am not going to belabor the point of how to build a good pitch deck. There's really good content online on this. If you want a sample of great pre-seed or seed based on our own opinion, we've done 100 fundraises in the last few years. As a company, we've raised more than $300 million for our startups, raising from a Series C for one of our companies that will be announced in a few weeks that it'll be about $56 million on a $400 million pre, to a $500,000 round for a pre-seed company just getting first product to market. There is no scenario we haven't seen, and there's a lot of variation in pitch decks, but a lot of them follow a very similar pattern, because you have, as we talked about earlier, 60 seconds before they say no. They don't say yes for 4 to 6 weeks. So you have 60 seconds where the goal of this first meeting is, can I get to the second meeting? So have your story ready. Always open with a simple summary so you can help the investor quickly put you in a pattern. I'm a consumer internet business, pre-launch, coming out to market in January. I've been in beta for the last years with 1,000 users. I'm raising money to accomplish X. Quick summary. Be ready to be interrupted a lot. The person across from you does this for a living. They're going to be a hugely quick study. They're probably going to read your mind about what's going to come out of your mouth next. That doesn't always lead to the best manners. I get it. But this is a rapport building exercise. Don't let it fully throw you off your game. One of the first things we'll do with our entrepreneurs during pitch prep is we will impersonate really difficult investors. And we will interrupt a lot, just so that we can see if we can fluster the entrepreneur kind of on purpose. And then last, and this one is admittedly controversial, let's say I'm raising $1 million for my young company. And I meet an investor who, when I ask my initial questions, they say, we only write a minimum of $2 million checks. I'm being provocative for a purpose just to make a point. I promise you, I am suddenly raising $2 million that day. I'm going to modify my ask as long as it's within reason for the audience in front of me, because if it's not a fit, it's not a fit. Now, if the investor in front of you says, I'm private equity, I'm going to write only $20 million checks, it's not a fit. Don't waste each other's time. OK, let's get to the pitch. You're going to open, I'm a Series A enterprise SaaS business. This is an example from our portfolio. We met them when they were 3 people in pre-seed. They raised Series A last year. The business is now single-digit millions. They're going to raise Series B, I hope, at the end of this year. Our pain, we have a SaaS education platform that eliminates musculoskeletal injuries from large corporate businesses. You know, people who have to lift things and pull things and shift things for big shipping and logistics companies, they're breaking down and getting hurt. It costs everyone money. That's what we fix. Here's our solution. Our team, we're looking for founder market fit. Our team are experts in human movement and experts in learning management systems. Traction, we reduce injuries massively. Here's data point A, B, and C with trends going up and to the right. Go to market, here's how we generate leads. Here's how we win them. TAM, here's why this could be a really big opportunity. Competition, here are the enemies and why we're sustainably different from them. Financials, here's what we've earned. Here's how we make money. Here's how we can get bigger. Here's what we're raising now. Here's some appendix slides. This was a super abbreviated version because I'm not going to spend a lot of time on pitch deck today. If there is someone in the audience who wants to talk about that further, happy to. It's actually a topic I strangely nerd out about. Just not really the purpose of this. I want to give you guys the overall framework on how to be ready to fundraise. OK, some tips. 1 message per slide. If I have to interpret your slide, the slide sucks. It's either immediately intuitive or you got to get back to work on the slide. I would like you to imagine that if I didn't see any of the content in the slide and all I could read was the top headline, and I flipped through them for the 12, 15, or 20 slides that you had, does it tell a contiguous story? Don't give me a slide that says team and a slide that says finance. There's no freaking story to that. I'm seeing 2,000 of these a year. And if I like the story that you're telling me, what I'm going to ask for you to do is send me the deck so I can socialize it with my colleagues. I am explicitly telling the venture story here, not the angel story. There are variations. And if in the Q&A that happens today, I'm happy to talk about some of them. But for venture, I have colleagues I need to socialize this opportunity with to see if collectively we want to make this investment. And if all your slide says is team, you haven't taught me anything. Build appendix slides for the predictable questions. There are 28 questions all investors ask. There is 0 reason for any entrepreneur not to already be ready for all the questions investors ask before you sit with them. What we love our entrepreneurs to do is before they fundraise, they write out the answers to all of them. They practice them. They recognize which of their answers suck. They use their close colleagues, their advisors, to tell them, answer number 4 is shitty, answer number 8 is amazing. Is number 4 lousy because of the answer or because it's a part of the business that's underdeveloped? And if it is the latter, what are we going to do about it? In this presentation, I'm going to take you quickly through all 28. And if you take notes, I'll even tell you the answers investors are looking for in those 28. Be ready to demo if it's appropriate for your business. Answer direct questions directly. How many folks in this room are founders or thinking about founders and have a super technical background? Hands up. Hands up. Awesome. This tends to be a little harder for you. If I ask you a question of, do you have revenue right now? Often what happens when I get a super technical founder in front of me, they're incapable of just saying, no. Instead, they give me this novel that ends with no. Please reverse that. The color is important. Don't lead with the color. You're simply going to annoy the investor because what they're trying to do is just get a sense of stage really quickly. Financial projections. We're going to get into those in a bit. I just want to set an expectation that if you're really early stage, you still need to have them. No one expects them to be right. They expect them to be evidence of how you think. OK, build in big reveals. Since all investors ask the same questions, there is no question they won't answer or they won't ask prior to actually giving you funding. If you know one of your answers to that question is amazing, then don't put that answer in the deck. An example. We had a robotics business in our portfolio. Interesting product, already out to market, first customers, team is super capable. The founder is an expert in patents. He had written 26 of them. A lot of them had already been awarded. He had spent very little money on doing it because it was his expertise. We did not put it in the deck because it was 100% sure it was going to be a question that gets asked. So instead of putting it in the deck and pulling out all of the juice of that moment, it was a Steve Jobs one more thing. Because eventually the investor asks, who's the competition and how are you sustainably different than them? And my founder could just say, like it was off the cuff, like, oh, sorry, I forgot to mention, we have a patent portfolio 26 deep. And you could watch the investor's mouth hit the table. Build in reveals. It'll make you more memorable. And the goal of the first meeting is simply to get to a second meeting. Last but not least, I knew this founder. He had actually founded a company based on a smart chair, personalized HVAC in your chair. How many people in this room are hot? Great. How many people in this room, strangely, are cold? There's some of you. See, there's a hand. Thank you. If you could have actually controlled your HVAC on a per-chair basis, that's an interesting idea. And it's actually energy saving. It means you could take some of the expense out of the load of the building, et cetera. Except when he told the story, he could not have been more bored with his own company. And if he's not going to get excited about a chair company, an investor is not going to get excited about a chair company. There are people in this audience where showing that kind of enthusiasm and charisma is easy. And there are folks in this room where that feels like a bit of a stretch. Get yourself in your best mood. Don't be bored by your own company when meeting with an investor. Again, 8.2 years. They want to know you're having fun. OK, some additional tips. I know co-founders who bicker and fight, and they're like old married couples. That's awesome. Please don't do it in front of an investor. Number one thing that kills early stage startups is not lack of product market fit, is not lack of capital, is not a lack of a product that doesn't work. It is founder dysfunction. I see it every time. And it is the number one thing that an investor is looking for when they have the co-founders together. What is that energy like? So if you have the energy, like normally with your co-founder, where you guys like to just bitch at each other, great, love it. Don't do it in front of an investor. Because they're going to see it as danger. It's why great sports teams break up. It's why bands break up. It's why startups fail. Any question you get from an investor is not a question. It's implicitly an objection. An objection as to why they're not going to invest in you. So wait a minute, explain to me your background and what you did before this company? They're checking on founder market fit. So wait a minute, how are you different from that other company? They're checking on defensibility. Every question is an objection. So if you're the kind of entrepreneur that gets so focused in the moment when you're pitching or presenting that you actually can't take notes, there's no way you can parallel path, then fine, in those circumstances, bring someone with you, because you want to track those notes. Be ready to pitch without slides. There was an investor during my first company I was so excited about. He could not have been more perfect for what I was trying to do in the world. And I was very early in trying to raise money, and I was giddy. I couldn't believe I got this meeting. I had spent weeks prepping. I was in front of a mirror. I had my PowerPoint. I knew every slide, every inch, everything he could ask. And when I got there, he said, you know, it's a beautiful day. Would you mind if we just take a walk around the block and you can tell me your story? I bombed, like crickets level bombed. That walk was really short. He had no interest in continuing the conversation once we were back in the office. Last but not least, for pre-seed and seed, which I'm assuming a lot of this audience is, it's completely okay to say, I don't know. In fact, if you have a choice between I don't know and tap dancing, I don't know all day. Or even better, that's one of the milestones we're going to figure out in this next round of financing. Can't wait for your help to do that. There are microphones on either side. If folks have questions at any time, I know with my New Jersey Jewish roots, I like to just talk and actually with the microphone hear myself talk, which is fantastic. But if folks want to interrupt and ask questions on any topic, by all means. OK, mistakes folks make during this dance. One is you don't listen. You're working so hard, you're working so relentlessly, you're going so fast, you assume you know the next thing the investor is going to say, you cut them off, you finish their sentence. Again, they're viewing this partially through the lens of, is this someone I want to get in a room with for the next 8.2 years? Are you actually going to fully hear me? Are we going to fully hear each other? 2, jargon. Get rid of it all, especially in first meeting, what we call first date. Get rid of it. Make sure you are speaking about your business in absolute everyday language. 3, don't read your slides. Your slides should be rich enough so that when you send them after the fact, they can be socialized across the investor's colleagues so they understand what it is your business does and the problem it solves. But you should be conversational about your business. Don't be too informal. One of our founders, who I adore, he's a super sweet guy, he's really smart. He's just naturally really affectionate. And the first time he actually came to meet us, first meeting with our firm, he just walked across, started to offer unconsented hug. We had to ask, like, are you doing that with investors, buddy? And the answer is yes. We asked him to stop doing that with investors. I said, I'd rather you get invited in. The entrepreneur who says, especially a pre-seed and seed, and if you're a first-timer especially, I'll need to get an NDA in place before I'm willing to share that. The investor has instantly made up their mind, like, yeah, I'm not talking to you. We're done. Ideas are nothing. Execution's frickin' everything. And part of the reason that investors will just stop there is because they have another 1,999 companies who will not be that secretive with them. By the way, if you're working on something just outrageously scientific, and maybe it's even a tech transfer out of a university, or it's something on the life sciences or biotech side where you really do have that sensitivity, then give that kind of color to the investor. Share everything you can up until the point, but don't just slam a door shut. Solution selling. 30 years ago, the way to sell enterprise software in the United States in particular, and it's spread across the world, was I would try and sell you the software by just talking about the things it does, features. My product does this and this and this and this. So one of our companies is an example of this. One of our companies, if I were to tell you the solution itself, It's a wearable that women wear during pregnancy to track health of baby and mom. That's solution selling. I'm telling you the features and benefits. That doesn't work anymore. It certainly doesn't work in terms of storytelling to get an investor excited. Here's what it would look like if I told this story differently. I'm here to eliminate preterm birth from the world. Which of those do you want to hear more about? I promise you it's not the first one. Last, and this type of myopia when you're doing a startup for the first time is really, really hard. It's hard to get out of what my business looks like today. The investor actually doesn't care that much. I'd argue some of them, they don't care at all. If you are seed or pre-seed, what your business looks like today. They are building a fantasy in their mind about what you're going to look like 5 years from now. Help them with that fantasy. What's the mountain we're climbing? Don't pull them back into like, oh, but we can't do that yet. Of course you can't do that yet. Your team is 3 to 10 people. You have $10 in the bank account. You have a prototype that has smoke coming out of the sides. Of course you can't do that yet. But they are viewing you through a lens of 5 years from now. Help them. Engage them. That's pitch. Second of the 3 pillars is materials. Anything you tell in the story of your startup needs backup. If you were talking to institutional investors, if you're talking to professional investors, they're going to do diligence. Why are they going to do diligence? Because they only get fired for the deals they do. If they don't do their homework and invest in something, and that something goes really sideways because the business makes no sense or worse, ethical concerns, their limited partners will learn of this and they will not survive to the next fund. So help them do that homework. What does that homework look like? First, a financial model. Again, it's not about the precision of it. 100% of your models will be wrong. And like, by the way, grossly wrong, like not close wrong. But what's important is, does it demonstrate the kind of critical thinking that suggests you're taking a hypothesis-based approach to how you're going to play with this business over the next couple of years, and will you be, and this is really important, a good custodian of their capital? This isn't monopoly money. It's $1 million of real people's money. The investor represents those people. They might actually have a small portion of those dollars themselves, but they want to know you're going to be a good steward. Your pitch deck, we discussed this, you might have 2 different versions. You might have the version you present versus the version you send out. The one you send out might have more text, might have more commentary, so it's easier for someone to interpret who wasn't in the room with you. 3, your cap table. For entrepreneurs unfamiliar with the capitalization table, it represents the ownership of the entity. If you're unfamiliar with this phrase, then I never, ever, ever want you to build this yourself. It is surprisingly complicated. Please have your rental CFO or a lawyer do this for you. This is one of those documents. It's a little bit like the third rail in a category in politics. You can't ever be wrong about this one. If you're wrong about this one, the slippery slope in the investor's mind is, what else are you going to be wrong about if you're not going to be accurate about who owns what in this business? A demo, again, that's going to be business specific. Some of you don't need one, some of you will. If it's hardware, you're going to need one. If it's consumer internet, you're going to need one. Product data. You're going to need evidence of what they're going to look for is engagement. Do people use, frankly, do people give a shit about whatever the thing is that you're doing? And the fact that people on your team tried it, or that it works in a lab, or that this random beta user that happens to have your same last name is raving about it, none of that counts. Is there product data that indicates an outside audience is engaged? There's something habitual, there's something useful. And then the 28 questions. Okay, we're going to go through a lot of questions. Some of these are going to feel so obvious to you, you're going to wonder why I'm boring you. I promise you it's worth writing these answers out. For a lot of these, there's a question under the question. I'm going to try and go through some of the questions under the questions reasonably quickly for you. The answers to these aren't on the deck. Some of the answers to these are going to be unique to your business. A lot of them will be unique to your business, but you will get a sense of the rhythm to these. What is the problem you are primarily trying to solve? This should be succinct, short, evocative, simple. What is your solution to that problem? What is the thing you're bringing out to the world? What makes your team qualified for the opportunity? Investors look for founder market fit. You've been a neuroscientist for the last 20 years, and now you're coming out with a clothing brand. What? You've been an athletic coach for 10 years, and now you're building a technology that better communicates with high school athletes. Oh, that makes sense. I built analytics businesses within the hospitality and casino sector, and then I ran casinos, and then I built a SaaS analytics platform that I sold back into hospitality companies. Founder market fit. Yes, sir. Love it. So the question was, what if you have no qualified experience and you're just starting for the first time? Then, sir, you have some recruiting to do. Because at some point, what the investor wants, if we go back to my earlier slide on arrogantly likable, they want to know they're sitting with someone who is a master of that domain, and if it's not that person, then they want evidence that you can recruit masters of that domain. Who are the co-founders? How do you know each other? How long have you worked together? My co-founder is amazing. I met her 3 weeks ago at this conference called Montreal Startupfest. No. If you met 3 weeks ago, that's great. Now go spend the next year getting to know each other. Co-founder relationships, I have an admittedly reductive view of this. I think only two things matter. One is, would you trust them with that which is most important to you? And two, are they really smart? You have those two things, you can talk about anything. And you can figure out anything. To get to that level of intimacy and trust, there aren't that many ways to accelerate that beyond just spending a lot of time together. But the investors are going to ask because all startups go through hard frickin' times. There are valleys in this. How many folks in this room have been through a really hard time with their startup? Which is why any of you here, when you meet a solo founder at this conference at any point in the next couple days, buy them a fucking drink. Because that job is hard. They don't have someone else to pull them up. What skills are missing from the team? All young teams have gaps. It's nothing to apologize for. It's just something to be honest about. I will share with you, here's what the investor would dream of hearing. The product works. The technology works. We know the market. What we're missing are the sales and marketing front end to go put things in the top of the funnel. I don't care if you're B2B or consumer. Move those customers through a customer journey and have them engage a product that is absolutely rock solid and works. Investors love investing in things where technology risk has already been eliminated. What proof do you have that your solution works? As I started to share earlier, this needs to be, to the best of your ability, data that you didn't just generate yourself. That someone outside of you that is not incentive aligned used the thing and it worked. And you have quantified data for it, like things you can measure. And ideally, you even have a reference where the customer says, yeah, that's my data, and I used it, and it's freaking awesome, whatever that means. If you're a consumer, this is about growth and engagement and low churn. What's the market you sell to? Who is your customer? These questions, I have a B2C version of this as well. I don't know how the audience skews B2B to B2C. I should have asked that earlier. Sorry, I'm already running. But who's the market you sell to? If you happen to be B2B, more specific, the better. One of the counterintuitive things about startup life is that if you want to go really, really fast, I want you to think really, really small. I want you to have the narrowest definition of a customer segment that has an incredibly specific pain that is really causing blood. Sorry to get dark on you, but the harder it is, the more they will try your thing. Because if you can solve that pain, oh my God, you got me. Then you can create what is the dream. This white-hot center of evangelism of people who are using your product, loving your product, talking about your product, and will get on stage for you or do references or leave reviews. So figure out the most narrow way you can so that you can answer to the investor, here's the world we're going after, but here's where I'm starting, and here's my evidence that that works. And the more specificity, the better. How do you reach that customer? If you are pre-seed, you have no idea. It's founder hustle. Whatever guerrilla tactics you can use, you're going to do it. If you're seed stage, you need to at least be able to talk to something that sounds like a repeatable funnel. It'll be admittedly a bit hand-wavy, because you won't have that much data yet. But you need a story, and that story needs to line up with the financial model. How many poker players in the room? Anybody? No other degenerates? Only like a half a dozen like me? Great. Room 203, 4 o'clock in the morning, chips. Sorry. If you want to bluff in poker, I'm giving you insight into the kind of conversations I had with my dad when I was 4. If you want to bluff at poker, the number one most important thing is consistency. Consistency of how the table views me, of where I'm sitting at the table, the kind of cards that are in the middle of the table, how many chips I have. They all implicitly have to tell the same story. Welcome to early stage fundraising. Everything has to tell the same story. So, if I say to you, here's how I'm going to get customers, and here's how they're going to convert, and here's what they're going to pay, and that's my answer to these questions, those same answers have to be reflected in how you present go-to-market in your pitch deck and how it shows up in your financial model. They all have to tell the same story. One of our companies went out to market, and they didn't understand why they were dying in due diligence. They kept getting second and third meetings with investors and then fading away. And what we realized when we did a little bit of forensics is the entrepreneur for us said, we're going to win every customer by winning a first small deal and then expanding across the business. So we were going after these huge, giant enterprises, and we were going to sell this one small deal at $50,000 a year, and then get that evangelist inside these large corporate conglomerates and sell internally in that way. But that's not at all what the financial model said. So investors didn't believe him anymore, and that's all it takes. You need consistency across all of it. So here's the thing. Every time you guys come out with a new thing, every time any entrepreneur comes out with a new thing, you're going to get the question of if that pain really exists in the world, then people are solving it already. How are they solving it already? Because your solution better be 10x and 20x or 100x better than what's out there already. So you're going to get the question. It's not an easy conversation to have, especially given how theoretical and early your business is. By the way, I'm not suggesting any of these answers are easy, but you're all going to get the same questions. Write them down. How do you sustainably generate leads? What are the KPIs you live on? If you are pre-seed or seed, this is hand-wavy shit. You don't know. It's okay to say you don't know. You can say that this money is designed to be able to kind of get that kind of repeatability. But once again, whatever your answer is needs to be reflected in the financial model so that you have consistency. How do you price your solution? How do you earn money? Please, God, make this answer simple. We have a monthly prescription fee, and then we get transaction volume on top of it. We're an ad-supported network. Oh, we sell the thing once, but then there's an annual maintenance fee. Simple. And it has to line up with the financial model. What is churn today? What are the primary causes of it? Don't be embarrassed about it. When you're early stage, your product is messy. The likelihood that someone tried it and didn't use it a second time is predictable. It's fine. One of the biggest mistakes entrepreneurs make when they engage investors early is they try and hide and cover up the bad stuff. You can't. They all ask the same questions. They are super motivated and rightfully skeptical because they all meet 1,000 entrepreneurs that say, we're crushing it, everything's amazing. And because that's the audience they have to engage, they have to show up reasonably skeptical. By the way, for the entrepreneur that engages the investor that's cynical, just walk away. That's no fun. I wouldn't want to be in a room with that person for 8 years either. But skeptical is reasonable. Because they're skeptical, they're going to ask these questions. And if we have bad news, I promise you you're better off being upfront about the bad news. Because here's the worst thing you can do in that first meeting. Hide something, get the question anyway, be defensive in your answer. They're out. They have too many others they can meet. How do you measure engagement? How do you measure whether or not people are using and benefiting from your product? What's required to deploy a new customer? How hard is it? Here's the answer they're looking for. Plug it in, man. That's all you need to do. It's easy. Has to be true. This will all get backed up because they will do customer references. They will do a demo. They will ask questions. So I'm not in any way, in a million years, am I suggesting you to lie. What I am suggesting is this is the prism through which investors are going to view your opportunity. Know it, be ready for it. And the areas of your business that shine, be proud of it. The ones that are messy, don't hide it. So if deployment today is messy, fine, own it. Remember, they're viewing you with a lens of 5 years from now. Help them into that fantasy. It's messy now, but when we do this and this and this in the roadmap, here's what it looks like then. Fucking telepathy, it just gets started. What are the per unit economics of the business? This is really important. The investors out there won't care as much, it's going to sound a little weird, about the base fixed cost to run your operation, as much as they will be super curious to understand what is the contribution marginal benefit of each customer. So I bring on a customer, it costs me $50 to get them in the top of the funnel. It costs me $4,000 to get them all to a signed contract. It costs me $6,000 to actually get them deployed and live. And within 4 months, I make my money back. And by month 5, I'm profitable. How many SaaS companies in the room? Awesome. If you email me, I will send you a Bible or two on SaaS KPIs. All investors are looking at the exact same numbers, magic number, cash payback period, LTV to CAC. They're all asking the same things. There is some really great content out there. It's easy for me to just press forward and a link so you don't have to hunt for it yourself. Question? Oh, I'm going to finish it. We'll get there. By the way, it's just jonathan@etwadvisors.com. Easy to find. That'd be funny if I did all this and never showed it, just ran, got into a car. What else do you have in the future on the roadmap? What else are you going to build? And what other customer segments will that unlock? Who are the competitors in the space, and how are you sustainably different? OK, here's an important one. Question under the question. When an investor asks you anything about competition, they're actually not asking you about competition. They're asking about defensibility. They're asking about whether or not there's a moat. Said differently, if your young business starts to win, and let's call win $5, $10 million in revenue, you have left the cute little scrappy stage, and you're now full-on adolescent. When you reach that place, enemies are going to see you, and they will want to kill you. This is the game. The investor is going to want to know now, while you're still cute and scrappy, how are you going to protect yourself then? No one expects you to have a moat and a castle and alligators in the moat and armed guards out front. No one expects you to have that today. They do want to know if you've thought about it. Because here's the trick. For venture economics to work, power law. They need billion-dollar outcomes. They need really big businesses. Just for the math of venture, they need to bet on companies that can scale really fast to really large outcomes. So they are viewing you through a lens. If they are managing a $50 million, $100 million, billion-dollar fund, they are looking at you through a lens is, can this be a company worth $1 billion? And the only way to get to that size is to ultimately be able to fend off competition when you're no longer cute and scrappy. No one expects you at pre-seed, seed, even Series A to have any kind of material definition of moat yet. They do expect an answer, a thoughtful answer to that question. At pre-seed, the answer can be, I don't know. What do you think? You've seen this dance more times than I have. Here's some of my theories, but I don't know. That is completely viable. It's not the best answer, but at least it's viable. How much capital have you raised? There's no gamesmanship here. Just be blunt. If your cap table is a little messy for some reason or another, just tell them. What does the cap table look like? What they're trying to now evaluate is the second part of the lens that they use when they talk to a startup. So entrepreneurs, please understand that an investor is actually using two very separate lenses when they talk to you. One is, do I like the business? The other one is, do I like the deal? They're completely independent questions. I have a company of ours. The business is great. They've been growing solidly 80 to 100% for like 4 years in a row. The team is strong. The CEO is just this lovely, heart-open, super bright, workaholic guy. The cap table, fucked. He owns, God, like 14% of the company at this point. And as a result, investors really don't want to put in any more money because they can't see a path where the CEO would own enough for this company to reach scale. Because while it's been growing at that rate, it's still a small business. So investor after investor gets super excited about the business, and then they look at the cap table and say, there's no deal here. So that's a conversation to have with an advisor. It's a conversation to have with your attorney. If you have something weird on your cap table, before you even engage investors, how do I answer this, or is there some cleanup should I do? Primary use of these funds. The answer to this question is a story. The answer to this question is, I'm launching for the first time, or I'm growing my go-to-market function, or I need to build this integration to someone else, or a partnership over here, whatever it is. It is not just hiring people. Hiring people are a means of unlocking some next business milestone. Start with the milestone, then talk about the people. And if you guys have listened, consistency matters. We're all playing poker. Whatever's in that answer needs to be reflected in your financial model. Everything says the same thing. How much total capital do you need to reach scale? Okay. How many here, and I'm not being playful with this question, I'm serious with this question. How many people here really want to build the biggest fucking business they possibly can? Awesome. Great. Love it. So then there's only one right answer for you to question number 22. Feel free to write it down. I can't wait to answer that question with you. I am trying to build a giant fucking business. It will need gobs of capital to get there. I am building a business that I believe, this is their dream answer, that is capital efficient, and we could push to profitability if we wanted to, but that's not really my mission. I want to build this as big as I possibly can, and I'd be so excited for you to be a part of that discussion for us to decide how much and when to raise. The reason that answer is so important is, again, I need you to operate with empathy for what the investor cares about. If they're running a $500 million fund, and 4 years from now, your company exits for $75 million, you have wasted their time. They want giant outcomes. So if you want a giant outcome, they want a giant outcome, that's freaking great. Put it on the table, go for it. In terms of the amount of capital over the life of the business, as much as the business can handle. If you succeed, who might buy your company? The answer they want is one that's filled with options. If your answer to this question is, this technology is purpose-built for Oracle to buy me in 3 years. That is a shitty answer. Single point of failure exit. Great, good luck. If instead your answer was, well, large software companies could buy us and large ERPs could buy us, but frankly, payments companies over here could also be an avenue. Let me talk you through the logic stream for all three. Good answer. Because one, it means you've been thoughtful about it. And two, again, operating with empathy for the investor, they need liquidity. One of the primary ways they can get liquidity if someone buys your business. Would you be willing to step down as CEO? OK. Second controversial question and answer that I'll offer to the room. There's only one right answer to this question. This is a test that investors appropriately apply called rich versus king. Would you rather be rich? Would you rather be in control? So, there's only one right answer here. You guys ready to take notes again? Man, that enthusiasm. It's like just washes over me. It's so good. So the right answer is, I only want to win. I am the right CEO for the business right now. I know it, but I only want to win. So if this business gets so large and complex and sophisticated that I am no longer the right person, I would be so fucking excited to have that problem and talk to you about that problem to go find the right person. One of my founders, this is his fourth company. He has 3 exits. His current company is worth almost $600 million. His business is well approaching $50 million in revenue. He is tough as nails, early 50s, former military. And when we prepped for, this was 2 years ago, when we prepped for our Series B and we got to this question, we have our founders write out these answers in a Google Doc. And I was going through his answers, and I get to question number 24, and in big capitalized letters, it just says, fuck no. When you're at your fourth company, you can say that too. What valuation are you seeking for this round? This is an extremely different answer if you're raising a small amount of angel money. For those who want to explore that thread, I'm happy to chat after this session. It's a really different answer. If you're raising venture, if you're raising institutional money, this is one of those questions I super recommend you never, ever answer. I have lots of friends and partners in the venture community. I know that what I just said is not popular for them. Right now, I'm on this stage trying to help entrepreneurs, and there is a tension that exists that is just natural between venture and startups. And venture wants to invest in the best possible companies at the best possible price, and the entrepreneurs want to get as much capital from great investors as possible while selling as little of the company as possible. There's a tension, it's on the table. You as entrepreneurs are prepping for these meetings. You answering what price you want can't serve you well because you can't be right in the answer. Only 2 things can happen. Either one, you set too high of a price and you've scared them away because you've shown yourself to be potentially too dilution sensitive too early, or you've shot too low and you've just negotiated against yourself. So here's your answer. This is entrepreneur judo. You're taking the energy and you're tossing them. Valuation is only one of the criteria involved in this decision, and it's not even my most important one. I'm looking for a partner who's already been through this dance before, can help me see around the bend of this company. I'm super curious, since you see lots of companies and you're obviously spending time with us, what is it about us that feels like a fit, and how could you help us beyond just the capital itself? What did I not do just now?
Answer directly.
I never answered directly. So I just went back on the very thing I was advising you guys to do earlier. Because the direct answer for this one does not serve you. Most investors will poke at this at least once. It is in their best interest to do that. Most investors will not ask this question twice. I will say the provocative thing that if they ask a second time, it's predatory. Once. If they don't get the answer, there are really normal realms for what makes sense for pricing by market, by type. If you're a SaaS business, I'll give you an example. If you were to Google search 2019 SaaS funding napkin, I think it's Point 9 Capital that puts it out. It's really good. It's a nice, simple deconstruction of seed to A to B on what are the qualifications of a given startup and what are the prices therefore. Would you be open to taking more money this round? Another question where there's only one right answer. And it's more complicated than saying yes. You've already suggested you want to build a giant business. So if someone says to you, would you be open to potentially taking more capital this round? One, a little buzzer should go off in the back of your head that probably should remind you to say, like, what is the size of the fund with whom I am chatting right now? Bigger fund means they want to write bigger checks. So it's possible that that question is simply self-serving to try and get the entrepreneur into their ideal investment profile. It's not a negative thing. It's not a malicious thing. It's, I'm trying to find a fit here. But it's also potentially a way of testing the entrepreneur of, do they have big eyes? Are they capable of greater ambition? Have they thought about going faster? So the answer to the question is, here it is. Yes, if I had more money, I could accelerate in important ways A, B, and C. But of course, and here it is, I need the economics to work for all of us. The entrepreneur who in that moment raises their hand and says, I'm not willing to sell any more of my company. The investor is running for the door. Oh, got it. Super dilution sensitive. We're going to fight every single time we think your business needs more capital to try and grow into $1 billion business. Good luck. Instead, a recognition that what the investor needs, both the new one and your prior ones, as well as what you need, all of it matters as you think about figuring out what the financing would look like, what the amount the raise would look like. What's your timing for a close? So this one's tricky. There's no one answer to this question. What you're trying to do is put investors and run a funnel, just like you would on sales side, just like you would in recruiting. And so you're going to start to set expectations after you've had first meetings or second meetings or third meetings with investors, where you're working backwards from an end. You need to be able to create some scarcity so the deal actually gets done. And what I mean by that is, every day a deal doesn't get financed for you, your business is a slightly less risky. Every day you've figured out a little bit more. So every day an investor can delay a decision with you. It's actually in their interest because they want to see if you can graduate a little further. Every day you don't get money, you know you're going slower than you otherwise could, or worse, you're getting that much closer to just saying, I'm done. This tension exists. It's part of, unfortunately, the game. And so your ability to credibly describe to the investor, here is where I am in the process. I have finished all my first meetings. I'm starting to have second meetings. My timing is that I should be meeting full partnerships in approximately 2 weeks or 3 weeks or 4 weeks. Now at least you are setting an expectation with the investor for how quickly they need to move if they want to be a part of this transaction. And make no mistake, if an investor is interested, they're going to find time for you. If they are not interested, they are not going to find time for you. Either one's okay. What's not okay is sitting in the middle and not knowing. We're going to do that. The question was, what's the average window or what's the time frame? We're going to do exactly that in a moment. Last question, last of the 28. Again, I really recommend writing them out for yourself, practicing, flashcards, make them conversational so that when you're talking to the investor, you absolutely know your business. And by the way, here's the mind game here. It's not just you learning how to have the conversation with the investor. It's you learning what the critical components are of your own business. Because if there are questions of those 28 where you have not asked yourself them at all yet, then there's a blind spot in how you're building your company. Who else are you talking to? Yet another question you will not answer. This is another judo one. There is no value in you answering. It does not help you. If someone has already put money into your company, by all means, share that name. But investors are super motivated to get as much data, as much diligence as possible every time they're talking to a startup. So if they're talking to me and I say, oh, yeah, I'm talking to Jill over at Investment Co., the likelihood that they will find their way into a conversation with Jill is really high. And then Jill might share one of two things. Yeah, I decided to pass on them. That's going to influence the investor who called Jill. Or two, Jill will say, oh, I'm super interested too. Do you want to go approach them together? And guess who just lost all pricing leverage in that negotiation? Instead of two investors, I'm now talking to one. So this is another example of, who else are you talking to? Well, I'm a consumer internet business, so I'm talking to all the players that you probably know, frankly. But what's really important to me is to find a partner that I'm not going to answer the question. OK, last part. Third pillar, investors. The best introductions, and this is really important as you build an investor list, all three of these pillars need to be ready before you fundraise. The third part, great introductions don't come with disclaimers or caveats or qualifiers. Great introductions sound like this. Oh my God, you should meet Jennifer. Just don't ask anymore. Just fucking meet, please. Just go meet her. That's the dream introduction. The shitty introduction is, would you please fill out this form on our company's website that includes an upload thing for, it's probably not the warmest introduction. There is no, I wish there was, there is no secret magic pixie dust to suddenly have 20 great introductions. It's just fucking hustle. It's just networking and hustle. This is the CEO's job. We believe that CEOs have three primary responsibilities. Neglect any one of the three at your peril. Number one, know where the ship is going. What's the vision of the business? Make sure everyone's aligned on it. Number two, make sure you have all the right people on that team. Number three, make sure the team has the tools it needs to win. Part of number three is fundraising. Lines, not dots. There was a great post a number of years ago. I'm a little confused if it was Mark Suster or Fred Wilson. I think it was Mark Suster. If I've met you once, I have one dot on a data point. If I've met you twice, I can draw a line between the two, and that's the start of a relationship. And investors want relationships. They don't have time for really deep ones. It's not going to be super intimate. They're meeting thousands of companies a year. But what they would love is the rare opportunity to get to know an entrepreneur that says, here's what I'm trying to do in the world. Here's what matters most next. I'd love to talk to you in 2 months and have another cup of coffee when I can prove to you that I've already done those things. And then we can get aligned on what should happen for the business next. There's a lot of work to that. This is why part of the reason why having a co-founder can be so useful, because when you're fully in fundraising, it's so distracting. It's hard to actually fundraise and continue to move the business forward. So for the teams, I don't know, you don't quite have the most beautiful trust, or you're a little codependent with one another and you want to do everything together. Please don't do all the fundraising as a team of three, needing to all be in the same meetings, because the company is going to just stall. Trust each other. Let one person drive the fundraise. The rest of you go build the business. When the investor gets legitimately interested, he or she will want to meet the rest of the team anyway. Be wary of investor-to-investor introductions. What I mean by that is if there's an investor who super likes your business but isn't investing, but they want to introduce you to other investors, probably not useful. The one exception to that will be if you meet an investor that only writes $50 million checks and you're trying to raise 500 grand. Okay, they could never have invested in your business, but signaling matters here a lot. So if one investor passes and they talk to another investor, that second investor is going to be really influenced by that first passing. There's no substitute for hustle. There is no secret sauce to building an investor list. You can craft the list through some tools, and if you want some hints on how to do that more efficiently, that I can help you with offline. But to actually get to know and build those relationships is just work. I super recommend getting to a list of 20 before you even start if you're raising a venture capital round. And please remember, every time you meet an investor in any circumstance, it's a pitch. Practice your story. So to your question, sir, what is the dance look like? We call it the minimum viable funnel. First date, second date, business diligence, partner meeting, legal diligence, closing. Minimum 4 to 5 months from that first discussion up through money in the bank. Shit ton of work. This is not the funnel for angel. This is the funnel for venture. Okay, so I've gotten my introductions, and I set up first meetings. You want to have your meetings clustered together? Have them all be together as much as possible, maybe over a 1 or 2 week stretch? Because you're going to learn a lot in those meetings. You're going to learn, like, ooh, I was missing this in the deck, or this answer in the 28 isn't landing. You'll learn faster. A first date is 30 to 60 minutes. It might be anywhere, might be in their office, might be your office, probably not your office if you're pre-seed to seed. And you're going to just take them through your pitch deck. It's going to be one of them in the room. All you're trying to accomplish in a first date is getting to a second date. If you're on a first date with someone, it's not like, so what religion should our kids be? There's only so much you're actually going to get into in the first date. All you're trying to understand is whether or not you want to spend more time together. Second date, it will happen 1 to 2 weeks later. If they ghost on you, there are ways of trying to unlock that. It's not because they're mean or malicious. Sometimes it's poor etiquette. It's more just because they're busy. Or they're testing to see how much demand there really is for your business. So there could be a little bit of gamesmanship there. Second date looks exactly the same as first date, except there'll be more people in the room and the meeting will be longer. There are 2 things you're looking for at first and second date. First thing you're looking for, you want at least 40% of your first dates moving to second date. If you're seeing that, that means your pitch deck works. So when you meet with your friend over coffee and you decide to show your pitch deck, and he or she is like, oh my God, I hate slide 5, get rid of slide 5 sucks, and you're at like 70% first to second meeting, ignore your fucking friend. Let the data tell you whether or not you are tracking towards a raise. The other thing to look for, I don't care what words, another controversial thing, I don't care really what words the investor uses in that first meeting with you. First meetings tend to be pretty easy. What I care about is, did the meeting go over the assigned amount of time? So your leading indicators on whether or not your fundraise, which is a fundamentally binary exercise of joy or fucking pain, is whether you're getting those meetings in the beginning, whether those meetings are going longer than expected, and whether 40% of them move to a second date. Here's what a second date looks like. Same as the first date, it's longer, more people in there. Yes?
Is it a good thing for it to go over because they're giving you the time, or is that
Sorry. If it goes over, it's a great thing. Meetings with investors don't accidentally go over. They really don't. They're too busy. They're meeting too many companies. They've decided to, screw whatever the next thing is. This is worth going deeper on. If you survive second date, what's going to happen is every Monday, generally speaking, every Monday they have a partner meeting. And whoever your champion is in the firm, the person who met with you the first time, the person who organized the second meeting, she or he is going to come into that room and say, I've met this young company. Here's what I know. And they'll have a debate. They'll have a debate about what you gathered, what they know about the space, what have you. They're going to have a debate to determine whether or not this is a firm, this is a startup to spend more time with, whether this is a startup to enter business diligence. This is them understanding the question, do I like the company? Business diligence will last 4 to 6 weeks. It could last 4 days. Generally, though, we're talking about at least a month. And during that month, they're going to look for hard evidence underneath all 28 of your questions. in addition to those 28, the 5 or 10 or 15 that'll be unique to your company. The 28 are obviously generic. The 5 or 10 or 15 that'll be unique to your business. And they're going to want as much data as they can. And then they're going to research the market. And then they're going to get to know you. They're going to do back-channel references as much as they can. They're going to try and see, is the market big enough? And are the economics interesting? And is this team I want to spend a lot of time with? They'll ask you a lot of questions. If you survive business diligence 4 to 6 weeks, it will culminate with most firms in a partner meeting, where you will walk into a room. It'll be a boardroom. It'll be relatively intimidating. It'll be filled with, generally speaking, slightly older white men and Indian men. It's true. And they're going to ask you to do the same as the first date. And you're going to walk through your pitch deck again, and they're going to ask you a bunch of questions. And that is their final point, generally speaking, to decide, is this a company I want to write a check to? At the end of the partner meeting, within 24 hours, you're going to hear back from them, and you're going to hear one of 3 things. Either 1, we have a little more homework to do, and we'll try and wrap it up within a week. 2, no, we're out, and here's why. And if they're classy, they will share with you why, and you want to hear it, because they've gotten to know you for 6, 7, 8 weeks. Or 3, they're in. If they're in, this is an important one. If they're in, they're going to try and negotiate with you a little bit on the phone. Please, fucking God, don't negotiate with them on the phone. They're way better at this than you. Like, it's not close. If you are a wildly successful entrepreneur, you will negotiate a term sheet, I don't know, 12 times in your life. That's lunch. So instead, I am so excited. I love everything you just said. I can't wait to see it in writing. You know I'm not alone in this decision. I can't wait to pull in my advisor, my lawyer, my co-founder, my former investors to evaluate this, and I'll get back to you really quickly. And then you will go back and you will sit in fetal position, really nervously waiting for that email to arrive. Once you've gotten through that and you have a term sheet, if you have a term sheet from an investor and you sign it, in the US venture term sheets will get all the way to closing with money in the bank more than 90% of the time. There are some forms of venture in the world that have a lower close rate. Private equity has a much lower close rate. But venture, US, Canada, 90% plus once you get to term sheet and signed. So 20 to 8 to 4 to 2 to 1. Your first dates will take about 2 weeks. Your second dates will take about 2 weeks. Your business diligence will take 4 to 6 weeks. Partner meeting to get it scheduled, to get there and follow up, 1 to 2 weeks. It will take you about another week to sign the term sheet. And then legal diligence, this is otherwise known as confirmatory diligence, otherwise known as make sure entrepreneur did not lie to me diligence, will take 30 days. Money in the bank. So when we meet entrepreneurs who say, hey, I'm trying to raise my first venture round, and I'd like to do it in 45 days, I would too. Not how it works. Okay, curveballs to watch out for. Investors want to show you value outside of just writing you a check. It's leverage for them and value to you. So one of the things they'll do, particularly if you're B2B, but even on the B2C side, it'll just be more about partnerships than customers, is they will offer you introductions. And you will be super flattered, and you will just say yes. Oh my God, IBM, yes! Please don't say that. Like, just deep breath, beta blockers, whatever you do, just calm down. Because what they're also doing, besides trying to show value to you, is they're also diligencing you. So they're going to introduce you to executive at Big Co that could be a fit, but you haven't qualified that person. So you could end up on a phone call that's a total waste of time for them. And then the investor who is super interested is going to call their colleague, and the colleague's going to be like, there's nothing here. So instead, when that offer is made by an investor, please respond with, I am so honored, thank you. There's a specific type of customer or partner I want to meet. Here's the criteria. If that aligns with the person you're thinking about, fucking great. If not, let's see who else in your Rolodex makes sense. I love that I still use the word Rolodex, like that hasn't existed since 1978. Second, Request for a financial plan. This is another one where I super recommend you don't just send it over. They're going to ask you for it after second date. Can I see a version of your financial model? Don't just send it over. Instead, say, can we set up a brief call, and I'll walk you through it. It'll take 20 minutes. And they'll say, I do this for a living. Just send it over. And you'll say, I do this for a living too. No, thank you. Walk them through it to make sure they understand the critical assumptions so they don't draw incorrect conclusions or assumptions about how your business operates. And you have to spend the whole next meeting unpacking these false assumptions that they've reached, as opposed to getting it off the ground in the right way from the start. Last, customer references. Especially for the B2B audiences in the room, investors are going to ask to speak to them. They're going to ask to speak to them early. For your early stage businesses out there, you only have 1 or 2 or 3 references at most. They are a precious, precious commodity, and you can't ask your most important customer, hey, would you mind talking to 9 investors? Like, that's crazy. So instead, what I would suggest is when you can, be judicious about when to say yes to that. And when you need to say no because you simply don't know the investor well enough yet, say that to the investor. I love where this is headed. Our chemistry is really good. Let's leave the customer references to the end so that you're fully comfortable in all other parts of my business. And then I'm thrilled to introduce you to X because they're going to say great things about us. Quick ones. Cluster your meetings. The more that they're jammed together, the faster you learn. Always work backwards from a closing date so that there's always a little bit of pressure. Yes, we're going to try and close around August 30th. If you're going to raise an angel round, I promise you we could have that conversation outside of here. But if you're going to raise an angel round and there's an investor who says, you know, you don't have to pull the whole thing together. I'll give you some small amount of the money now. Please just say yes. There's more nuance to it than that, but just say yes. Get your documents ready and your wiring information. Don't lose any time with the simple stuff. Every day a deal is not done is a day the deal is still at risk. And use investor updates. As you get to know investors ahead of a fundraise, send them information periodically. Here's what I said I would do. Here's what I actually did. It worked out well. And think like a home seller. What I mean by that is, if you feel really strongly, given your investor list, that you could pull together $250,000, great. Tell the world you're only raising 200. That way you get to tell the next set of investors you had more interest than you expected and it's oversubscribed. It's like a show that's been sold out or is about to sell out. Scarcity bias is a powerful thing for all of us. Investors are not immune to it either. At the end of this dance, you're going to have investors who are circling you. And it feels like they're interested, and they've spent weeks with you and lots of meetings, but you're not quite at the finish line. And you're wondering how to get them there. Like any good sales process, forcing functions can be useful. Like you're about to launch whatever the thing is you're going to launch. You're signed a major customer, or you're about to sign a major customer. You're actually oversubscribed, and you're going to gather your board to decide who you're going to grant fundraising allocations to. Or maybe one of the angels that stepped in is someone that has real celebrity. The greatest forcing function you can imagine is I already have an offer from another investor. I bring these up because if you have investors circling but not getting right over the finish line, these are the kind of things that can unlock someone. A colleague of mine who's been a successful investor in the Bay Area for 30 years, what he said to me was, it was a funny moment, but he said, Jonathan, we're always interested in putting less until someone else wants to put in more. Social proof is a really powerful thing. So evidence that either the market or other investors are leaning into your business, real evidence. I'm not saying just lie or bullshit or gamesmanship, like real evidence that you can credibly share that there's pressure on this round is a good thing. But please don't be the entrepreneur that just walks up in front of the investor and says, this is going really fast. I have so much more interest. I'm going to close in a week. If none of that is true, don't do it. Reputation risk is high. Be the entrepreneur that the investor knows, oh, this one will never get me fired. I'm going to finish with this question. There is one determinant of a successful fundraise that matters more than anything else. One single biggest determinant of a successful fundraise. Question. What's the answer? No, sorry. When you all talk over each other, it's really hard. Yes? Whether I actually go out and do it. I think you're right. Wait, give me a little bit more. What does do it mean?
Well, like, you can't raise funds unless you actually go and meet with people and raise.
Oh, nice. Okay, good answer. Yeah, I like it. The inevitability that it's going to happen. The fundraise is going to happen. Yeah, love it. So the confidence with which you show. Anyone else? Persistence. Okay. Here is the single biggest determinant on whether or not you're actually going to fundraise. It has nothing to do with the fundraise. Do you have the evidence that you're building a sustainable business? Do you have evidence that you're building something interesting that the world needs and that people will use and that will create value? The fundraise is a lagging indicator. There is a professional way to fundraise, and I've walked you through the framework for it, but nothing matters more than if you're starting to build the pieces, the DNA, of what ultimately could be a big business. As promised, my contact information, my name's Jonathan Lowenhar from Enjoy the Work. Really appreciate everyone's time in this, cool, chilly day. Thank you.